Good morning. It's Monday, July 31st, 2023. This video is on gold miner performance relative to gold, the differences between gold itself and investing in a gold mining company. First, let me say that let's talk about some gold chart technicals. Gold continues to impress with its resilience, its relative strength in the face of more Fed tightening and rising bond yields. Um, yeah, gold gold is just very strong, all things considered. Now, we had an interesting thing happen at the end of last week where the futures contract, the front month, flipped from August to December. Um, so now that contract is the most actively traded one, and we call it the front month contract just because it has the highest volume. It's the most liquid month out there. And so all the charting platforms have switched to the December contract. And that sort of creates a little bit of a skew in the price chart. Really, spot is around 1970 right now. So the August contract would be about 1970. But a lot of the platforms are using the December contract, which is now above $2,000 an ounce. It makes the chart look a lot better. But uh, regardless of that, the fact is 1970 is a pretty good price, and gold continues to consolidate near all-time highs, within 5 or 6% of all-time highs. So from a weekly or monthly long-term charting standpoint, gold is really strong, and it continues to build up energy for that potential breakout to new all-time highs later this year. So if gold is doing pretty well, why is the GDX still at 31, 37, and even off of its highs of just a couple of months ago and well off its highs from 2021 and 2022? Um, there's a lot of reasons for this, but the simplest one is just simply stated: gold mining is not a very good business. It's very capital intensive, and generally, because it's capital intensive and it has significant regulatory risk, it has a higher cost of capital than other industries. Also, mining, pulling metal from the earth, is by its nature extremely challenging because the metal in the earth is not consistent. It's not the same grade all throughout. It's different widths, different densities as you go into an ore body and extract that metal. It's complicated, time consuming, and energy and capital intensive. So, Robert Friedland last weekend said, the mining business is not for a smart person. If you were smart, you would write an app and sell it to Mark Zuckerberg. Now, obviously, that's a hyperbole. That's a bit of an exaggeration. Not everybody can just write an app and sell it to Mark Zuckerberg. And there's plenty of apps that have been written that didn't amount to anything in terms of real economic value to the author, right? But I will say the point is well taken. I mean, making software, programming, building a website, building an app, way less regulatory risk, way less capital intensive than building a new mine, making a new discovery, going through the permitting process, getting the green light for financing, constructing that mine, and then actually operating that mine. A whole different ball game. And that's why the mining business just simply isn't very good. Also, mining is always a target of environmental groups, different entities that are sort of lawyer factories that just want to create lawsuits Mining is an easy target. It's as an industry, the mining sector is an easy target. Plenty of examples from the past of environmental damage, spills, um, abusive labor practices, you name it, it's happened, right? So the mining industry is an easy target, and very often, my companies are going into uh, areas of the world that aren't densely populated. Usually, there's some sort of indigenous group or groups in the area, and again, it makes an easy target. You have a foreign mining company coming into an area where they don't have a lot at stake, and they're trying to extract metals from the earth in an area that is sacred to an indigenous group, right? So all the optics are terrible. Now, obviously, there are plenty of mining companies who are responsible, who do good work, who create dialogues and investment partnerships with indigenous groups and with locals, stakeholders in an area where they are operating. But just generally speaking, the mining industry is a target worldwide. The mining industry is a target. So if we just look at this GDX chart, gold rose to 1920, 1923, 70 to be exact, in 2011. The GDX was like $60 a share or thereabouts in 2011. Today it's $31 a share. So let's just call it 50% haircut in the last dozen years. Meanwhile, gold is actually up on that time frame. Gold is actually up since 2011. It's actually gained value. If you bought at the exact all-time high, August 2011, 1923 an ounce, and you held it to today, you'd still be showing a profit, even though you would have suffered a nearly 50% drawdown at the 2015 lows, right? But gold mining stocks, whole different story. You'd be down 50% here if you just held the GDX for the last dozen years. Why is that? Well, a lot of it has to do with the fact that the cost of mining gold, that all-in sustaining cost, has probably more than doubled since 2011. So it was one, $600 or $700 an ounce. Now it's $1,300 or $1,400 an ounce. So margins have shrunk. Margins have been pressured, and also the industry as a whole has made a series of bad investments over the last decade. So a lot of acquisitions made at relatively high valuations, buying projects that either didn't get permitted or had major cost overruns. I mean, literally, the gold mining industry is kind of a study in capital destruction, and just looking at the Newmont quarterly report, I've probably tuned into a dozen Newmont earnings calls. I've looked at probably a few dozen corporate presentations from Newmont. And this company has a very strong tendency of always saying that the year is back end loaded. They'll have stronger production in the second half of the year. Costs will drop in the second half of the year. And this happens quite regularly. I wouldn't say it happens every year, but it is definitely a common theme from Newmont and the gold mining industry more generally. So once again, 2023, it's a back end loaded year for Newmont. You can see Australia, the Boddington mine is one of Newmont's stars. But even in Africa, they have a mine that's got all-in sustaining costs up to 1461 an ounce. And that's in Africa. That's a lower cost jurisdiction, right? North America, cost blowouts in Quebec, in Ontario, uh, you know, really high costs here. And a lot of this has to do with the fact that the production at these mines is lower than expected, right? South America, again, you can see costs are high, Penasquito is the star, uh, but even that has ceased operations. So that's another major cost problem because it's on care and maintenance, right? Labor strike. So, and then Nevada, 1388, all in and out. So, I mean, just look at the costs here from the world's largest gold mining company. Look at the costs of mining gold. Now, all of these mines are built. So you could say, well, we should focus on the cash cost because the mine's already operating. But at the end of the day, the cost to shareholders is the all-in sustaining cost. And that's really where these companies are being valued at. A lot of people focus on PE ratio. PE ratio kind of misses a big part of the picture. You want to look at return on equity, ROE. And for Newmont, because they had negative net income, the return on equity right now is negative. Now, it's probably not going to be negative later this year, but it won't be a big amount. The return on equity is net income, divided by shareholders' equity. So return on equity in the mining sector is not great. Look at Kinross, 0.1%. Pull up Barrick, 0.5%. Okay, so 0.1%, 0.5%. And then for Newmont, it's actually negative 3.8%. So the return on equity for these three gold mining companies is abysmal. Let's look at a tech, uh, a mega cap tech star, Microsoft. Return on equity, 38.2%. 38.2%. Gross margin, 68.9%. So the quality of profitability of Microsoft is in a whole different stratosphere from a company like Kinross or Barrick. Here's Nvidia, return on equity 20.9%, gross margin 56.3%. Apple, return on equity 165.7%, gross margin 43.2%, profit margin 24.5%. So just a whole bunch of green here in these profitability metrics. And that's why these companies have so much higher valuations. If you just talk about PE, oh, Apple's trading at a 33 PE. Well, you're missing a big part of the equation, and that is that so profitable, such high, return on equity and such strong profit margins for companies like Apple and Microsoft. And that just doesn't exist in the gold mining sector, the GDX. And look at Newmont's chart. I mean, so look at Newmont's chart, compare the return on equity, and then look at the NVIDIA chart and compare the return on equity. Okay, it's simple. Gold mining just isn't a good business. Um, and for the sector to really outperform, it needs a rising gold price. I mean, that simply put, they're not making enough new discoveries and costs aren't stable enough that they can be consistently profitable and generate strong margins and return on shareholders' equity. Okay, that's it in a nutshell, right? A rising gold price, let's say gold went from 2,000 to 2,500 in the next 3 or 4 months. Yes, that would be the perfect tonic to create a big share price move across the gold mining sector. But 20 to 25% gold rallies don't happen every year. In fact, they're pretty rare. Um, we've already just had a tremendous move in the gold price from October of last year, from 1625 to 2000. So that's already a tremendous move that just happened recently. And the gold miners certainly have not moved in a they haven't outperformed that move. Okay, let's say that. Yeah, we've gone from 23 to 31 in the GDX, but that's not a terribly impressive move when you're talking about a $400 rally in the gold price, right? So the gold miners continue to underperform gold itself, not generating that outperformance, that margin expansion that investors really want to see. But in the next breath, I say all this, and I say gold mining is not a good business, and it's not. But imagine if we had relatively stable inflation back down to that 2% area. We didn't have big spikes in fuel costs. We didn't have to raise workers' wages 10% or 15% every year. Let's say they were rather stable or just moving up with the CPI of 2% a year. Then suddenly, the business of extracting gold and selling it on the market might be a much better business. So we shouldn't completely turn negative on the gold mining sector, but we should be realistic at the challenges this sector faces and continues to face, and the low profitability and return on equity that the sector, generally speaking, generates. So that is why gold miners are not performing very well relative to the gold price. Gold itself, however, is not a business. It doesn't generate earnings. It doesn't have a dividend yield. It doesn't have a return on equity. Gold simply is a store of value, a timeless store of value with no counterparty risk that basically, thinking really long term, big picture, is the inverse of fiat currency. So, as fiat currency, like the US dollar, the euro, the Japanese yen, as these fiat currencies continue to depreciate over time, the relative value of gold in those fiat currencies, in those paper currencies, will continue to appreciate. No labor strikes, no missed earnings, no mine permitting. Gold is gold. It's heavy, it's beautiful, it's shiny. And if you drop it on your foot, it's probably going to hurt. Thanks a lot. If you enjoyed this video, please like and subscribe for more content just like this.